All right, yes, perfect. So what did we talk about in the previous video again? We talked about our stop loss placement. That is where if we take a loss, etc., then we have a great stop loss placement. Absolutely perfect. Now, we will also take winners. So we also have to have the right take profit. What are our targets for an entry, a pattern, etc., for our actual entry? That is what we need to understand. So with that comes basically three things that we have. Where the first thing is we want to always ideally aim for a 1 to 2 within the context. That's the first thing. Then the second target is, if that doesn't happen, okay, a context low / high. Remember the fourth foundational level right there in the top right. That is the fourth one, the target, the context high, context low. Then the third one is where we have the draw on liquidity, because that leads back to the bias, where the bias led to a draw on liquidity right there and led to the premium rate or discount rate that overall we want to target. That is the next one we want to aim for. So what does that look like? Well, here again, let's understand the monthly time frame. On the monthly time frame, we had this monthly fair value gap that we are overtaking. Then we are potentially creating a bullish fair value gap. We've gone over this narrative, the bias a lot of times. This right there is the closest premium array on the monthly time frame. That's quite far, right? That's quite a far premium array. So let's go into the weekly to see if we have something. On the weekly, we have this swing high sitting right there. So that is the closest premium array that we can now target. Perfect. Once we understand that right there, we can now use that as our draw on liquidity. That does not mean that we take 15-minute entries towards the draw on liquidity every time, blah, blah, blah. No. We first need that context again, that narrative right now. We have this draw on liquidity. How are we going to deliver there? On the daily time frame, we have this right there, this daily fair value gap sitting right there that we can push higher off of. So here we look for, again, our 15-minute entry pattern, 15-minute ST plus RE, or of course the 1 hour ST alone. But we have the first target, which was the context high. Excuse me if I went a little bit too fast. We have the daily discount rate towards the daily premium rate. So this right there creates our context, right? This is where we take entries inside that context. This as well is now the first actual target. That's the context high. The context high is the first target. So a context high or low is always going to be the first target. After that, the next target is the draw on liquidity, which is this one right there. But we always need new context to deliver towards that draw on liquidity. That is very important. So here right now, if we go into the 15-minute time frame of that daily fair value gap, then we can see we had that ST plus the RE. Again, the ST, the displacement in right there, to then the displacement out, sitting right there. Which then created the RE, the new order flow leg higher, which confirmed order flow, which also is, of course, our entry pattern right there. We enter off the float, if that's what we choose. We covered what? We covered that stop loss or that swing low right there, because that is what we talked about in the previous video. Then what do we target? Well, the first step we talked about is ideally a 1 to 2 within the context. That's our ideal thing, what we would want to have. Doesn't really matter what's to the left of that. Ideally, just a 1 to 2, something along the lines of that, within the context. So within the context, we need to, of course, understand what is the context. The context was in between the daily fair value gap towards that premium array, the daily premium array, and for that swing high. This right here, this gray area, is our context area. So if we can get a 1 to 2 within that context area, that's perfect. Because we also now need to understand is the probabilities again. What did we talk about in the probabilities? The highest probability is that we are likely going to have a rejection of the daily fair value gap. So this 1 to 2 inside that context doesn't even require us to fully follow through and take out that context high. No, we just need a small rejection in the form of that 1 to 2. that is beautiful, because that, of course, is the highest probability in the high probability price action. Where the next probability, which is still high probability, but it is a lower probability than just a rejection, was that entry pattern. And then the next part is that it's a winning trade, that entry pattern. And then we had the take profit. And then we had the lower probability thing to happen is that we take out the context high right there. That is, of course, still high probability, but within that high probability, we can define that even more, where that high probability becomes a little bit lower probability than just a rejection. Because, of course, a small rejection in the form of something like this to happen is way higher probability than for it to actually take out that context high right there. Because in order for us to take out that context high, we need to first have that rejection, then the entry pattern, then we need to follow through off of that, and then we need to take out the context high. Requires quite a lot of things. So the next part is, all right, well, now we understand the probability. What is the lowest probability? It's to actually follow through. It's to create a new daily fair value gap of that previous daily fair value gap, which is, if you were to target, the next draw on liquidity right there. So that is how we stage that, where the highest probability you ideally want to have is the first thing. Ideally a 1 to 2 RR within the context. Then the next part is, if that doesn't happen, okay, then we can aim for the context low / high. That is our ideal thing. Ideally also around a 1 to 2. And then the next is a draw on liquidity, the overall draw on liquidity that we had established. But this is also where the correlation between win rate and RR comes into play. The more RR you are going to target on every single trade, the lower your win rate is likely going to be. So the lower the probabilities of hitting take profit on every trade. For example, if you're always aiming for a 1 to 10 RR, your win rate is likely going to be around 20 to 30%. Now, with time, that can, of course, increase. But for myself, and what I think is the best approach overall in trading, is to find the perfect balance. Because I do not like to have a low win rate, because that's going to require a lot of mental points. It's going to require a lot of psychology hits that I take before I take the next winner. So the way I see that is, if our win rate is 20%, and out of 10 trades, I take 8 losses and then I take 2 winners. Am I going to keep my psychology in check for those 8 losses in a row before I take 1 winner? Likely not. I'm likely already blowing an account by the time I reach that next winner. So that's not something I want to do. So I want to find that balance right there. Finding that balance is done through aiming for a 1 to 2 RR is what I have found to be the sweet spot. With a 1 to 2 RR, you are likely going to start off with around a 40%, 50% win rate. So keeping that expectation low, where eventually my stats from this year is 1 to 2 on average is what I aim for, and it's an 80%, 80 plus win rate. So I win 8 out of 10 trades, which is great for a 1 to 2 RR. We just need to understand, in order for us to achieve that, first we need to get used to the strategy, and over time we will get better at it as well. And when it experience that time also takes over, you can also achieve an 80% win rate. So you can also achieve that. It's just important to understand that that also takes time. So you're going to start off with a lower win rate and work your way towards that 80% win rate. It's a really fun process though, because you can see the process overall in your data and in your trades as well. It's really fun. So how do we do that? That is by understanding, again, that we have first, the highest probability is ideally a 1 to 2 RR within the context. Then we have the second one, it's a context low / high. Third one is the draw on liquidity. Now, if there is any questions as well, then yes, we can also aim for a 1 to 1 and have a higher win rate. But that is not something I would do, and that's also why I just don't like it personally. It's because when we then take a loss, it's like we're constantly set back. So if you're stuck at in the beginning at a 50% win rate, then you have winner, loss, winner, loss, winner, loss, winner, winner, loss, loss. And you're constantly in this break-even cycle right there, which RR helps us to get out of overall. So the 1 to 2 is what I found to be the sweet spot to still, in the beginning, we're likely going to have a lower win rate, but we will still be profitable. And that is important. So that is what we're trying to work towards as well. All right, so what does that look like? Well, the first target is quite easy, right? It's just a 1 to 2 inside the context. So the overall context was, again, this context right there. The discount rate towards the premium rate. In between that is the context. 1 to 2 only requires a rejection. Perfect. Then the next part is a context high right there. Now, that can also be a target, just knowing that it's lower probability and likely you would have been tagged out at break even right there before you even got the chance to see that winner. So this right there would be lower probability. The lowest probability target would be the draw on liquidity that is sitting right there. And then eventually you would have even, if you weren't break even at all, you would have gotten tagged out right there before it eventually hit your take profit. So it's also important to see, it's all relative, right? We know where price is likely going. We are traders, so we like to get involved right there on that right move. But we can't trade without a stop loss. So a lot of times, the longer your target, as in the more take profit, this is a 1 to 15, a 15 RR. That's absolutely insane. That is not something I would advise to do. Then that right there is likely, very likely going to tap you out 9 out of 10 times before it runs to your take profit. So here, it's very nice to understand as well that the 1 to 2 is likely where we are not going to tag out before it hits our take profit. Then the next part is that context is also likely where we are not going to tag out. Then the next draw liquidity is where we could get tagged out because that is the lowest probability target. So this is what we're going to work with, and this is the targets as well. This is what we're going to be using for our next few examples. Where right here, if we go and zoom out to the 1 hour time frame, then we can also understand right now, we had that 1 hour ST sitting right there. We covered that low based on the previous video. Can we target a 1 to 2 within the context? Then ideally we want to do that. Right there, 1 to 2, that's beautiful. That's absolutely beautiful. That's very nice because now you only need a rejection. You don't even need for it to follow through right there. You just need a rejection. Then right there, we even follow through on context high. And that is also quite nice. You could have targeted that as well. And then eventually that draw liquidity. But for that draw liquidity, ideally, of course, after context is taken, you want new context. Because we can do something like this. Take out the original position and then move higher right there. And that is, again, the 3 levels of targets that we have. Now, is it very important to target very specific things within this context right there? Not really. That's not super relevant. Doesn't really matter. If anything, you can look to target potentially swing highs and swing and fair value gaps right there inside of it. As long as you understand just a 1 to 2 is perfectly fine right there. And then the next target being a context right there. That's as easy as you get. And if you incorporate that, then you already incorporated, all right, we might target swing highs and swing lows, etc. So here, if we zoom out again and go on to the next example, then we have the weekly fair value gap sitting right there. That weekly value gap, again, we know the story by now, is where we can continue higher off potentially, reach that drawn liquidity, eventually look to deliver into the weekly fair value gap right there. Daily, unusual context overall in the 4 hour and the 1 hour as well, where the 1 hour had, of course, this fair value gap lower right there. And as you can see, I am going to do the bias, the narrative right here a little bit quicker because we've gone over it quite some time right now. So as in we've gone over it quite often. So right here, I also think I can do it quicker right now because I assume you've been following along with the videos, right? So, all right, then here we can continue lower off this 1 hour fair value gap to target the weekly fair value gap. which then becomes the weekly fair value gap right there is the overall draw on liquidity. That's the draw on liquidity right there. Then we have the first target is actually this context low sitting right there. Fair value gap, premium rate to that discount rate. There's the first context low sitting right there. So that is the first target, with the next target being that draw liquidity in the form of that weekly fair value gap. Perfect. If you go into the 1 minute time frame, then on the 1 minute time frame, we can as well see that we had that entry pattern again sitting right there. This entry pattern, if we enter off the flood, it would have been something like this. We covered the 5 minute fair value gap right there, which is because there was a 5 minute fair value gap. So we cover the bodies right there, like we talked about in a stop loss placement. So what do we target right here? Ideally, first checklist, ideally a 1 to 2 within the context. This is the context. Do we have a 1 to 2 within the context? No. Okay. We can understand this. As in, this trade is still valid. I would still take this trade. It's just we understand that it might take a bit longer before we actually hit our take profit. And it wouldn't be crazy that if we take the context right there and then reverse towards our break even or towards our stop loss right there to then continue to the take profit. So the trade overall becomes a little bit lower probability. Still high probability, don't get me wrong, but within that high probability, it is a little bit less high probability, as in it's a little bit lower probability. But right here, what is the next step? Context low / high. Context low right there. All right, 1 to 2 beneath the context low, which ideally, of course, well, it's just not ideal. But all right, that is then the next target. 1 to 2 below that context. Perfect. We can look to target that. And eventually, if you want to work with partials, then what could you do? You could work with partials at a 1 to 2 and then look to target the overall draw liquidity in the form of that weekly fair value gap, which would be right there. Now, you can work with partials. I personally do not like working with partials because I do not think it's worth it. The swap you pay right there to hold overnight, for example, if there's a news event or even the market, of course, closes and we have to roll over, the spreads open up. Is that all worth it to keep on holding towards that drawn liquidity? Whilst if we were to close at a 1 to 3, we would have almost the same outcome if we just, as if we partial at 80% at 1 to 2, and we then hold 20% of the original position towards that 1 to 5 right there. Yeah, is that really worth it? In my opinion, not really. So I don't like to partial. I always like to close the full position because I feel like it's more worth it. There's more pros to it, and that's how I feel about it. Again, if you eventually think my data supports of partialing, then let's partial. But right here, this is where I don't like partialing, and I also just don't partial. I hold the full position to a number, which is usually a 1 to 2 RR right there, and then I close it out. So that is the next one. The draw liquidity is the next potential target right there, which again, the draw liquidity, the third step, is where ideally you just want to have new context to target that draw liquidity. So you're constantly moving in between that context to then have that draw liquidity. Now let's say the 1 to 2 was not within that overall in the 3 steps. So we could not get to a 1 to 2. Let's say we had a position like this, for example, just a random position, but the low, the target's already beneath the context low, and the draw liquidity right there is also doesn't allow us to have a 1 to 2 RR. Then in general, that is not really a position I would want to take, because I also, for my position that I want to take, I want to have a clear target the price can still run to. So here, this is not really a position I would take, but you can still take it as long as you understand once we reach the third level, the draw on liquidity, the overall draw on liquidity, we need to be break even right there. So you can still target that 1 to 2 as long as you're break even on the position. So that is when, no matter what happens, you would be break even on that position. Even if there's a reason to come back to price action, to come back to your entry level, you need to be break even right there. And that's also what we're going to touch on in the risk management video, of course, when we're looking to grow break even. So next example is going to be GBP US dollar. Right there on the daily time frame, we know the example already. We are coming off of that monthly fair value gap. Of course, let me mark it out again. This monthly fair value gap sitting right there. We can continue lower off of that. And we get that sign by having that daily ST right there. Beautiful daily fair value gap. We have a sting into it. Then right there, we can continue lower off of that. On the 1 hour, we can see a 1 hour ST. So the 1 hour ST right there, let's say this was our entry, the overlapping part. And we covered this high right there. Perfect. In that context, which is, if we look at the daily again, really quick, then we had the previous day low. So that creates the context. Fair value gap, previous day low. All right, well, is that the greatest context? Not really. What is the next thing we can potentially look to target? The next draw on liquidity? Well, I would argue it's this next daily fair value gap that is sitting right there. All right. On the 1 hour, what can we see? On the 1 hour, we can now see that we have this entry sitting right there. The first context low is right there. Can we reach a 1 to 2? A 1.2, a 1? Can we reach a 2RR within the context right there? No. All right, we can target a little bit lower, below the context low, a 2RR. Again, of course, that is lower probability overall, but we can look to target that right there. Perfect. This trade would still be perfectly fine. The next draw on liquidity sitting right there. So let's say our entry was lower and our entry was something like this, and this didn't allow us to reach a 2RR, the draw on liquidity, the overall draw on liquidity, then we can still look to target a 2RR as long as we understand once we reach this low sitting right there, that is when we definitely would be break even. So if you were not break even by that time, you would definitely be break even once we reach the target right there. That is, again, the targets that we use. It's truly not super difficult if I do say so myself. I think this is one of the easiest topics as well, the targets. So next example is where we have Canadian dollar CHF. Canadian dollar CHF, we of course had the weekly fair value gap sitting right there, where we can continue lower off of. Overall, the context was also on the monthly time frame, right there, continuing lower off of that. That created weekly context to continue lower off of that. And that right there, that weekly fair value gap created a 1 hour entry and even 1 minute entries as well. Where if we look at the weekly, then on the weekly, we saw the previous week low is now the target. So that is our context. Now this is a little bit more difficult because overall we don't have a clear draw on liquidity here anymore. Where now we need to look all the way to the left right there to create a clear draw on liquidity, which we can see is just a very long wick right there, which is not very ideal. Let's see if we have something in that long wick on the weekly. Not really. So here the draw on liquidity is just not super clear, which also means that when this overall draw on liquidity is not super clear, that's ideally not your highest probability pair, because the draw on liquidity always needs to be clear, in my opinion. I always like to have a very clear draw on liquidity. What are we aiming for overall? So right here, we only have this weekly fair value gap to work with and this context. So that context right there, the previous week low, is the draw on liquidity. And it's also the second step. It's the context low and also the third one, the draw on liquidity. So if we do take a look at the 1 hour, and by knowing that right there, then we have this weekly fair value gap, can continue lower off of that. Then we had this potential entry right there of that float with the 1 hour ST plus RE, of course. With the 1 hour ST, the 1 hour RE right there, covering that high. Can we target a 1 to 2 within the context? Yes. Perfect. So why not do that? And let's make it ourselves quite easy. Just being relied on a rejection. We don't even need to follow through. Perfectly fine. Then the next target would be the context, which is also the draw on liquidity. So that right there is the overall, the last target that we have. We can't target any further than this, because here we are targeting in the middle of nowhere, because we have nothing to target down there. So it's like, it's the absolute middle of nowhere where we don't know where it's now going to go higher from, because the overall drawn liquidity and the overall context low was that low right there. So that is our final target as well. So here, let's now look at this example where we came off that breaker right there. And we can now go into the 1 minute time frame to look at the potential entry. And again, what we are doing right here is we're setting levels, right? Where most important part is what you are doing. You're looking to ideally a 1 to 2 RR within the context. If we can't reach that, then you're targeting the context low / high. If we don't have a 1 to 2 RR below that and we reach the drawn liquidity before that, then we can look to target the drawn liquidity, as long as we understand that we need to be break even earlier, because we're targeting further as well. So here on Canadian dollar CHF, what are we doing? We are looking to continue lower, and the first target, the context low, is actually this low right there. Now it becomes a little bit easier because we have quite a lot to target right here on the 1 minute. We have this low. After that, all these swing lows come right there. So the next discount arrays right there, which are just, they act as another target, right? Then eventually we reach this low right there. So here we have quite a few targets. On the 1 minute, we understand that the first context low on the 1 hour time frame, so this low right there, as the first context low. After that, these are just draw on liquidities right there. Perfect. So what do? We have this ST right there. We come into it. Then we have the re as well. And let's say we entered off of the overlapping part somewhere around there. The low covering this high, it's what we discussed in the previous video. Can we target a 1 to 2 within the original context? Within this area right there? Yes, because what do we see right there? 1 to 2. Perfect. This is absolutely perfect. Now, here it is important to understand, just because you're using the 1 minute time frame does not mean that you are now all of a sudden allowed to target further. I've seen this before, and I see this happen quite often, where people think, but I'm using a 1 minute entry, so I should be able to have a further target right there. Yes, in hindsight, right here, it played out. But 9 out of 10 times that won't play out, because 1 minute entries require 1 minute targets as well. Meaning just a 1 to 2 and that context low right there. If you're holding for forever right there, no, that's 9 out of 10 times not going to work out. So the lower the time frame for your entry pattern doesn't mean the further you can target all of a sudden, because it just means that the target should be relative to your entry pattern time frame. Meaning, if you're entering on the 1 minute, 1 minute targets. If you're entering on the 5 minute, 5 minute targets, which just means that you're targeting a 1 to 2 on the same time frame, and you're also looking to target a context low, which on the time frame, of course, on the entry pattern time frame, is always an intermediate term low, which is your target, your context low sitting right there. So start off with a 1 to 2. That's the easiest target that you can have. Ideally within the context. If it's not in the context, you could target the context low right there or the context high. That is where ideally now we do want to watch, and we do want to take a look at risk management as well. What do we do once we reach that context low and context high? What do we do? What steps do we take? Do we go break even, etc.? All things that we need to take into account. All right, perfect. Thank you.